You've just been handed two offer letters. One promises $25,000 in immediate cash. The other, 2,500 shares in a high-growth startup. On paper, the equity looks like a path to wealth, but the headline value is not always the realized value. Which one actually wins long-term? Welcome to the ultimate showdown of executive compensation. Today, we're comparing cash versus equity to see which one builds more wealth. At its core, this choice is about a fundamental trade-off. Cash is certainty. It is liquid, it is guaranteed, and it is available right now. Equity, on the other hand, is possibility. It is conditional, it is tied to the future, and its upside is potentially limitless, but never guaranteed. Let's start with the cash bonus. Its greatest strength is its immediate utility. You can use it today to change your financial trajectory. Cash allows you to pay down high-interest debt, fully fund your emergency savings, or secure a down payment on a home. It solves problems in the present. However, remember that bonuses are often taxed as supplemental income. In many regions, this means a higher upfront withholding before the money even hits your account. Equity is the multiplier. While cash grows at the rate of your savings account or the stock market, equity can grow at the rate of a company's valuation. But here is the trap. Many candidates value equity based on the recruiter's expected exit price. That is a dangerous way to plan your future. Most equity grants come with the golden handcuffs, a 4-year vesting schedule. If you leave early, you leave your money on the table. If you have a 1-year cliff and you leave at month 11, you walk away with 0 shares. You are essentially paying for your equity with your time. Then there is the liquidity hurdle. In a public company, vesting shares are like cash. In a private startup, those shares are illiquid until an exit event. An exit could be years away, or it might never happen. Without a secondary market, you can't pay your bills with startup equity. Dilution is the silent value killer. As the company raises more money to grow, your percentage of ownership will likely decrease. For your equity value to increase, the company's total valuation must grow faster than the rate at which you are being diluted. This is not always a given. To compare these offers fairly, you must use the risk-adjusted value formula. We look at the potential value, the probability of success, vesting, and liquidity. A $200,000 grant with a 20% chance of success might only be worth $15,000 in today's certain cash. Not all equity is created equal. ISOs and NSOs have vastly different tax implications that can eat into your final take-home pay. If you leave a company, you may only have 90 days to buy your shares. If you don't have the cash to exercise, you lose the equity entirely. Choosing equity often means a lower base salary. This is your personal investment in the company. You are paying for those shares with your potential earnings. Ask yourself, if the company gave you that cash today, would you use it all to buy their stock? If not, you might be over-indexing on equity. Cash wins when you have high-interest debt, immediate lifestyle needs, or if you are joining a late-stage company where the moonshot upside is gone. Equity wins when you are at an early-stage startup with massive potential. You have a financial buffer, and your conviction in the mission is absolute. Never accept an equity offer without doing your homework. Ask for the strike price, the current valuation, and the total fully diluted share count. You need to know the path to liquidity. Does the company allow secondary sales? What is the investor preference? Don't be afraid to ask the hard questions. You can negotiate the mix. Try this. I am thrilled about the opportunity, but I'd like to explore adjusting the balance toward a higher base salary, or negotiate the terms themselves. Ask for a longer exercise window or an early exercise option to optimize your tax strategy. Harvard and McKinsey research shows that equity aligns your interests with the company's, but only if you actually understand how you win. If the equity feels like monopoly money, it won't motivate you. A well-structured cash bonus often provides more clarity and immediate drive. Statistically, the majority of startups do not reach a massive exit. This is why risk adjusting isn't just a good idea, it's a requirement for financial health. We all hear about the early employees at Google or Meta, but for every unicorn, there are thousands of companies where equity never reached its headline value. The winner isn't always cash, and it isn't always equity. The winner is the option that aligns with your current life stage and your risk tolerance. Cash builds your foundation and provides security today. Equity is a strategic bet on your future wealth. Choose the one that moves your needle the most. Which one are you choosing in your next negotiation? Comment equity below for our decision checklist and calculator. Don't forget to subscribe. Thanks for watching.